We like the fact that we build relationships with them and know their business. As I said, we're a full service firm. My background is I'm a corporate and securities lawyer. I've been at this for 35 years. Hard for me to believe that. I was with several law firms over my career. I started with Baker Botts, which at that time only had a Houston and Dallas office, and of course now is one of those big national firms. As Mark mentioned, I was in-house with a law firm for several years, and after the 08-09 crash, I joined forces with a friend of mine, Evan Stone, who was also at a activist hedge fund. We started our own law firm. We were kind of, people thought we were crazy to start a law firm in a down market, but we were in the right place at the right time. Dodd-Frank had just been passed, and we had the good luck of sharing office space, a family office, a fairly good sized family office here in town. As you know, under Dodd-Frank, the Congress said to the SEC, we want you to start regulating private equity, hedge funds, investment managers, multifamily offices, but we don't want you to regulate single family offices that are managing their own wealth. The SEC came out with a proposed rule defining what a family office is, and it was so narrow you would laugh. It was the person that made the money, their offspring, and their descendants, not their mother or father, not their brother or sister. They could only manage the money that they made. Of course, they could hire outside managers. We convened in this family office a meeting of all the big family offices here in town, names you would recognize, presented to them what the family office rule said, or the proposed rule, and to a one they said, this is terrible, we don't want the SEC in our files, we would not meet this definition. We wrote a comment letter to the SEC under our new firm's letterhead, Lee and Stone, but we got some of the old-time lawyers here in Dallas to sign off on it, people involved with Texas Bar Association, which I think helped the SEC pick up on it. When the final rule release came out, I felt like Steve Martin in The Jerk when he saw his name in the phone book, because the final release said, you know, see Skadden-Arp's letter, comment letter, see Lee and Stone letterhead. Of course, nobody knew who Lee and Stone was except those family offices that we had met through this process, which really launched our law firm. We later merged our firm into Gardier Wynn, which was an independent Dallas firm, now has been acquired by a big national firm, which is why I really wanted to get back to a regional Texas-based firm, and Carrington Coleman has been great. We're very much an old school middle market firm, love our clients, develop long-term relationships with our clients. And my practice continues to be focused on the investment management industry, particularly fund formation, either avoiding or embracing securities regulation, and just love working with registered investment advisors, like working with new managers who are launching funds. And with that, I'll turn it over to Doug.
Well, thank you, George. My career is sort of a 360-degree approach to the investment side. I started out as an institutional investor at was then New York Life Insurance. Now I think it's NYLM, New York Life Investment Management, doing what is now private credit, but was then, they just called it private placements. And I then switched to the Accel side, and I joined Barclays and spent time at Barclays and then Santander. And Barclays, I did a lot of European deals and US deals. And then in Santander, I did Latin America. and I ran debt capital markets for them, and so all the new issue business on the credit side. Then I left, and I started what would now be called a fintech firm. Raised the capital, started it, had a very interesting product, but it was sort of before its time and terrible timing. Building the product, raising the capital, we launched 2 weeks before 9/11. It was a software to process investment banking transactions. So you couldn't, and our investors and clients were investment banks, so they were not actually doing any real new business or hiring new products for the time. So I went to do distressed M&A for a few years. I did that because I had brought my company through a liquidating Chapter 11. So we did that, and then I did some M&A. That cycled out, and then I went into the fund marketing business, which I've done for the last, I guess, about 18 years. So started out at Babson Capital, which is now Barings, and did a variety of products that were all managed by them. Then I left and joined Perkins about 10 years ago. And we don't have any funds ourselves. We're a pure broker dealer, third party marketer, placement agent, whatever you want to call it, but we are registered. And I, several years ago, added the responsibility of being director of research. So which for me is quarterbacking the process. Everybody actually sources funds and looks for them. And then we have myself and one of my colleagues who do the deep dive into looking at the funds. And Perkins has been around for 25 years. We're a boutique placement agent, founded and still run by Chip Perkins. We were based in Connecticut, but during COVID, we moved. It became a virtual firm with a headquarters in Jupiter, Florida. And so, with the exception of Chip, who's there half of the year, people are all over the place. But I liked hearing what Dory said, because obviously we're big fans of hedge funds, and this has been a good, a better market for hedge funds. They may on average have a loss for the year, but it's a lot less than what the markets have lost, significantly. I wanted to have for this presentation, I wanted to have what has been lost just in S&P strategies this year, but I didn't get that number together, but I'm sure it's trillions, actually. So anyhow, that's me, and that's Perkins.
Well, one of the things I wanted to ask you real quick here is just, as director of research for a placement agent, take us through a little bit about what your role is there, what you're looking at, and what you're doing on a day-to-day basis.
Yeah, okay. So we look at about, over 200 funds a year, 200 managers. We meet, and they come in a variety of ways. First of all, we get them from law firms. We get them from administrators. We get them from LPs that we've, investors that we've worked with. We get them from referrals from managers that we've worked with. We get them from, we'll get them from the cap intro teams and prime brokerage teams, just anywhere. So we're every week, kind of week in and week out, we're looking at 4 or 5 funds, managers. And, a lot of them, many come forward, fewer chosen, I guess. So, a lot of them are really not at all institutional in any way, shape, or form. But we'd still probably, out of those, 200, we probably, we speak to all of them, but we probably have meetings with, 75 of them. And we hire 2 a year. We get hired. So we look at 200, we take on 2 a year, max 3. So with the process is all the due diligence that LPs do, we do the same thing. The only thing is that we have the only difference is we have to also take into consideration, is there a market for it? It's not just one investor cares, but will several investors care? Because sometimes a strategy is just completely out of favor. Or is the manager marketable? Some managers, their performance is fantastic. You know, it's like the restaurant with a great chef, but the experience at the restaurant's terrible. The food's really good, but nobody ever wants to go again. And we have the same thing with managers that we meet with, and you say, well, you're an 8-year-old fund, you have great performance, but you have $50 million under management, and you've fired 5 marketers in 5 years. I mean, it may be you. So.
No, greatly
That's, you know, a little
appreciate
bit.
that.
We use the tools to, you know, to analyze alpha. We use the quantitative tools, and if we get there, we do full background checks. We've had managers in the 10 years I've been there. We've had a few managers that have failed the background tests. You know, they might have had everything great on the resume, but at the end of the day, they were not worthy.
Totally get that. So just to sort of jump us into this discussion here, Dory did a great job setting this up. He may have been a little bit more optimistic than last month's economic outlook, where we spoke about the bubble of bubbles and things along those lines. But nonetheless, he touched on several things. You know, are we headed into a recession? Are we, you know, the inflation that we're seeing, supply chain issues, food shortages, oil, gas, war in Ukraine, all these things are out there right now. And they're things that investors are considering when they're making investment decisions. In this environment, Doug, is it your impression that the market is shifting from a seller's market to a buyer's market? And if so, what are the implications of that for both the family office and for the fund manager?
That's an excellent question. If the manager is what everybody wants, then the buyers just don't have any more leverage than they have at any other time. I mean, if you've got a queue to get into the fund because everybody wants to be in it, then they don't. But there are a lot less of them. So there is, I'd say, overall a buyer's market. And I think there's a lot of people that are not doing anything. They're sort of frozen. I was talking to a university endowment the other day, and they were telling me that the biggest problem they have is that they can't figure out their cash flows. So they have, they got to pay 5, 6, 7% of the operating budget of the college, or actually more than that. But they don't know all this money they put to work over the last couple of years that they thought it was going to, that it was going to be, they were going to have some realizations. And, depending on what market you're in the deals you've done, I mean, in some of the VC world, some of those deals, the multiple has cut in half. So a very good friend of mine's company, they're trying to sell it just early in the year. They were told it was going to be sold at 10 times revenues. It's now 5.5 times revenues. So now it's an 8-year-old VC-backed deal. So 8 years, the VC wants a realization. Now, the CEO, the CFO, the COO of this company are saying, we don't want to realize now. We're going to make very little on our piece. You can get your realization great, and you're still going to get 3x. But for us, we'd rather wait a year or two. Like we have the optionality. They don't. So there's things like real world things that are happening, but the buyer's market it really comes down to the strategy, the manager. If you've got what everybody wants, then it's not really they don't have any more leverage. But right now, if you're just a standard issue, long, short equity hedge fund, and you haven't generated a lot of alpha on your shorts this year, you're not going to raise any capital.
George, as you talk with your clients and particularly the ones that are doing fund formation, how are you viewing this right now in terms of the the
Mark,
conversation?
Sorry, let me interrupt you for a second. Marty said there's a question.
No, fine.
Yeah. Well,
Please repeat it so people
Yeah.
know what he said.
so there's a question about the trade-off if somebody's leaving their bank job to start a fund, and you have to have a certain amount of assets to break even, and how much runway do you need, and how much capital and thing, and yeah. Well, right now, fund formation on the hedge fund side is slow. It's about, I mean, it's as slow as it's been. I mean, and part of that is the success of some of these multi-manager platforms. The Millenniums of the world and Paloma Partners or whatever. So these guys, it used to be that the allocators didn't want to give money, or were not so enthusiastic about giving money to those multi-manager platforms, but they've switched. They're now quite happy to give it to a $20 billion multi-manager platform. Then the multi-manager platform can give some person who's coming out of Goldman or somewhere that's done really well, and they'll give them a $300 million sleeve, and they'll give them, not as good economics as he could get if he were to have 300 million on his own, but it's 300 million, it's a check, and it's a wholesale price, but it's pretty attractive. So yeah, there is, I mean, we've had a lot of, we do both de novo startups, we do managers, we've worked on a manager where the manager is $10 billion. And they come in, and sometimes they come in with lots of bravado about how they're going to have 75 million in their first close. They've got all this stuff lined up. And then they find they can't get the people. It's like herding cats. They can't get the people to actually give them the money. And they'll say, well, we don't have 75, we have 11, or whatever, they don't have it. And then we've had people come in, and the next thing you know, we're talking to them, and they leave and they go to a family office, or they do something else because they just say, oh, I can't take that risk. So yeah, that happens all the time. And we talk to people, and they'll talk to us for several years. I'm going to leave. I'm going to leave. I'm going to leave. And they don't. And it's just part of the, the process. And it takes a lot of guts to do it. And Marty just asked if fee structures have changed. I would say that they're more creative. I mean, what I mean is that, you got people who are doing stuff for full fees for, somebody gives $2 million, they're paying a rack rate. And there's people who say, well, if you give me money sooner, I'll give you a discount. If you give me money, I won't pay a management fee, but I'll pay you an extra performance fee. Or I'll pay the full management fee, but I want a discount on the performance fee because I know you don't have a lot of assets and you need the cash to survive. Or, or some of the multi-managers, they just pay them a stipend. They'll just say, here's your monthly stipend so you can live on it, and then you get to share the profits. I mean, I just did a co-investment deal with a guy, one of our managers, who it's like his best idea. And the guy didn't want to put the money into the fund because he doesn't like to do funds. So he's doing just this manager's best idea, and it's 0 and 20. But the manager right now in this environment can't raise any money. So he's like, okay, I'll take $20 million at 0 and 20. I mean, it's a $300 million manager material, and it's his highest conviction trade. So he said, well, and there's no offset. So if he loses money on that trade. It doesn't offset against the fund, you know, so against the fund and performance fees. So for him, it's if it does do well, he makes a lot of money. But fees overall, as the market has gotten more institutional, you know, if somebody's writing a $50 million check, they have more leverage than the person writing the $1 million check. And that exists in any business. So just like the fund business.
Are we back?
We are back.
Excellent. So George, I was just asking you, and great question there by the audience. So thank you for chiming in with those. And I think it fits in just what Marty was talking about. Where are the negotiations taking place right now? And what are how are they manifesting themselves? And as you're writing the fund formation docs, what are you maybe being more aggressive on and less aggressive on given the current environment?
So just to continue Doug's thought a little bit on the fee structures, I think, for private equity, maybe less so for venture, but for private equity, real estate, and energy, the fee structure's been the same forever, and it's kind of like turning a battleship, particularly for the larger managers. They're reluctant to negotiate fees unless it is just a huge investment. For hedge funds, I think it's a different story. It's also a different story if you're breaking out of a bank and you're starting your own fund for the first time. Same thing on negotiating other terms, whether it's how the waterfall works, the side letters, and whether or not they really want to be on a platform like a Millennium. So as far as, fees that are, or legal terms that are subject to negotiation, again, it really depends on the fund and the size of the fund and their pedigree. I do a lot of private equity. You do see some pushback on deal by deal waterfalls and institutional investors looking for a more European model overall fund return, putting in particularly on the deal by deal, very strict clawbacks, putting aside money to fund the clawbacks, negotiation of expenses, what expenses can be passed on to the fund, which expenses the manager bears, and the term of the fund. Obviously, for a hedge fund that's a open-end fund, there are no fixed terms, but you negotiate lockup, particularly if you want better deal terms, fee terms. You might agree to put a big amount in up front and agree to a 2-year lockup with reduced fees. I see that a lot. So that's pretty much it.
Great. Doug, as the competition for funding intensifies and commitments from investors take longer, how is this impacting the due diligence process?
That's a good question. For us, with did you mean from the investor side or from our side?
From the
I mean,
investor side is what I'm referring to, but
Yeah,
obviously
yeah.
it probably has implications for you as well.
Yeah, well, it's from the investor side. I mean, some of the investors we work with do incredibly detailed and really, really excellent due diligence, and some of them don't, and some of them focus on it's really just somebody crossing the T's, but they really don't know what they're asking. It's just a junior person, and they're just checking the box, and there's not really they don't understand what they're doing, but that's what they're being asked to do. They're taking longer. is I guess is they're taking longer. They're a little more, they've lost a little bit of nerve when the market, when you've got some 30-year-old who's never experienced this, and they lose some of their confidence, and maybe they bought some Bitcoin and they've lost $50,000 of their private that they thought or whatever they were getting. I mean, they're just taking a little longer. There's a little less courage. There's a little less confidence about how they're sure. We've had the person who did this co-investment. Throughout the whole process, I thought he wasn't going to do the deal because the way he was asking questions, there was such almost fear. I thought it was interesting, but I guess we see it's longer. It's a really long way to say it's a little longer. It's a little more, the managers are actually being pretty good about it. I'd say all the managers we represent, and we represent 4 to 6 at any given time. But the managers we represent are all right now very, very grateful for the attention of the investors, and they're willing to provide more information they might have provided. They might have gotten angry, a couple of years ago to fulfill some of their requests, and now they're kind of, well, I guess I understand all the stuff that's happened. Yeah, we'll get you that information. We actually find them easier, the manager more willing to provide the information, even if it's maybe ridiculous, but they need to do it. They need the investor to be comfortable. They'd like to have the investor to bear with them a long time. So they just want to make a good impression. But a couple of years ago, they didn't care as much.
So a little bit of a fear of making the commitment there. And George, I was actually just going to flip it over to you and ask you to add a little color. So why don't you go right ahead?
Well, I was going to actually ask Doug, obviously you work with a lot of institutional investors. Do you use their form of due diligence questionnaire? Do you have one that you've developed for your managers? Do you see family offices looking at due diligence questionnaires?
We have probably 80% of our managers, we make them fill out the generic, I see the ILPA one for private equity, or we'll do the AIMA, or there's a hedge fund questionnaire. They may not fill it out exactly, but they'll use, and actually probably half of them have their own form. So, I mean, it's really just brutal when people have their own custom due diligence forms, and it's 75 pages, and it's brutal because it's 90% of the same questions,
right?
They want it in their form. But it is what it is, but yeah, so we typically use those, and sometimes they have to modify a little bit to fit the manager. And a lot of times the process, if the manager doesn't have one, it's really helpful for them. They actually learn some stuff about their business that they maybe didn't even really know or hadn't been able to, and it helps them when they then have a question in a due diligence meeting or an ODD or something. We just had a manager we just took on. We're launching in, I guess, a week. They were so incredibly prepared. We went and, doing on-site due diligence, and they had everything. I mean, as a small manager, they have $70 million, but really professional. So it helps. And I think it helps their business.
Yeah, I agree with that. And Doug mentioned the Institutional Limited Partner Association, ILPA, and I highly recommend from either side going to their website, and it's open to institutional investors, family offices, sovereign wealth funds, and they have model documents. They have a model due diligence questionnaire. Some of their materials are only open to members, but even for lawyers and fund managers, it's great to see what institutional investors are looking at. I have found that limited partnership agreements are much more heavily negotiated now, even for emerging fund managers. In the past, I would see fund managers, a lot of the first fund managers would rely heavily on the lawyers to put out the first draft and weren't really willing to negotiate from there. I have seen limited partnership agreements be more standardized now, but still subject to heavy negotiation.
And George, you just mentioned emerging managers. Doug, I'd like to ask you, what role do they play in a portfolio, and how are they going to be affected in this environment that we're currently in? And
Well, you know, whether a manager is large or small does not make them, the manager's large and got great pedigree, doesn't make them immune to bad performance. It just makes them less immune to having, I mean, they're just better, easier to market, but they're not, you know, from your actual P&L at the end of the year, they're not necessarily any better. I mean, the managers we represent, our top manager is up 46% this year. And he's very small. But for a portfolio, we always think that it's good for somebody if they have, let's say they have 20 funds. They should, since these are living, breathing entities that go away and they merge and the senior partners leave and they spin off, and you should always be building a bench. I mean, you should be building a bench of smart people, and you know, could be 2 funds out of your 20. But to me, it makes no sense just to go, I'm just going to take these $5-10 billion plus funds, and that's going to be my portfolio, and assume that because they're big and huge, that's going to be a great portfolio. I mean, you don't buy stocks just because, oh, this is an old big company. And it's not a great best way to buy a stock. Oh, it's an old big company. Great. Should be, but go ahead, Marty.
Well, I was just going to say the family office that we launched our firm with, I know the founder who also had run a hedge fund prior to that, said he really liked emerging managers because they can be much more involved. They can pick their best ideas and they don't have to allocate among a huge spread. Of course, the manager is much more concentrated, but at the same time, if they hedge well and they really do their due diligence on the investments, I think emerging managers can often do better than a $2 billion fund that really has to diversify its investments and may not be able to concentrate on some of their best ideas.
Well, that's 1 second. Actually, I agree, and actually that points out something like a family office versus, let's say, a public pension. They might have completely different goals. So the family office might be saying, I want to make 15-20% over a cycle, you know, a little less volatility, and I want the manager to be completely aligned and totally focused. But the public pension plan, it might be, I need to be in the biggest funds, $10 billion that are on every consultant's buy list. And I don't really care if it doesn't have to make fair returns, as long as it makes 8 to 10 or 7 to 10, and it's less volatile than my S&P. I'm happy with that, and I can sleep at night. And but if you want to make the returns, then you might want to think about, well, is that investor base in that fund all very complacent with 7% returns? And if you're happy with 7% returns, but if you're looking for a little bit more, then you might want to be with a manager that its investor base is also seeking that, wants the higher returns. Yeah, so the 70 is a distressed muni strategy. So
Could you repeat it for us?
oh, I'm sorry. Yeah, so the question is how does capacity or a manager, what do you think about that, and what are the concerns or considerations? So yeah, what we think about it from a marketing perspective, because if somebody comes to us and they say, we've got $1 billion strategy, we have 200 million under management right now. If we can get to 250, could you get us to 250 and then we're good? Like, no, we're not. It's a hard job. We're not doing the hardest lifting and then walking away. No, we're not. But the capacity is capacity by sale, by strategy. The GP who goes into that business, if they don't really think about it, then they're really shooting themselves in the foot. I mean, we have one of our managers it's a total niche strategy, $100 billion max capacity, but it's a very high return strategy. But so his fee structure is his fee structure is very performance driven, and he hasn't made much money in the last couple of years, but this year he's making a fortune. But he's comfortable with that. It's a very small operation. But if you have got like a quant fund and you've got a lot of computer power, you may not have tons of fundamental analysts, but you might have a lot of computer expenses, and you might have a lot of PhD type people, and it takes a lot of people to run those firms. So I guess it's a long-winded way to say, I mean, you really got to think about it. You're launching a firm. You got to do the P&L and figure out, well, how much do I really need? And that's one of the questions we always ask in due diligence. How much runway do you have? Because clearly you're pulling out of your savings right now. What do you need to break even? And what do you need, yeah. Yeah. Well, it's it's a little bit of an America's Got Talent type of business. To the victors go the spoils, or we'll pick now one of our managers, we raised $1 billion for that guy. We started, he had 20. He now has 6 billion, and he's probably got 300 million now in his pocket. He started with 5. So for some people, if it works, it can really work, but it's not easy. So,
sort of picking up on this point, one of the things we've noticed and spoken about in the past is there's a lot of great researchers out there, particularly in the hedge fund world, who say, you should be doing this, you should be doing that. But then when they actually get into the seat and they're now the CIO making these investment decisions, their performance seems to be not as great as you would think from reading their research. So how do you test for this if you're a family office? How do you how do you diligence that? How do you approach that conversation? That could be either one of you.
That's a great question. We don't work with anybody without a track record. And the second thing is we don't work with anybody without a portable track record. So,
Well,
you
let's
know,
assume for a second they've been with the firm. They didn't switch firms. They didn't leave the firm. So they're taking partial credit for this track record that the firm has established. They were the researcher. They informed the CIO, but they weren't the ones picking and choosing. But for the new fund that they're out marketing now, he will be the person or she will be
Yeah.
the person making those decisions.
well, frankly, that's a much easier decision for a family office to make. If a family office wants to hire somebody to do something in-house and to do a strategy, I mean, it's easier for them because it's their trust, it's not this broad marketing trust. So that's easier for them. For us, it's the closest thing I could say is that if let's say somebody was at an established hedge fund or venture fund or private equity fund, and they don't have the track record really but when they're going to launch their new fund, they're putting up capital and their former partners are investing. That's a huge endorsement. So we love it when you'll get somebody that they leave the firm and the other partners will say, well, here's $1 million. We believe in you. We hope the venture is successful. So that can help a lot. You get that endorsement.
Yeah. So some of it's how much of their net worth are they putting into this fund, and how much confidence do they put into their partners that they want to also step up, and the former LPs that backed the previous funds.
Yeah, exactly.
Marty, I know you see up front, and if you don't mind, I just want to do one more question because George and I had a pretty decent conversation about this yesterday. So, George, we've spoken about ESG yesterday for a decent amount of time. And I want you to just maybe talk about how ESG squares up with the fiduciary rule and where you see the SEC and what it's doing today with regards to ESG.
Sure, happy to talk about that. And obviously, ESG means different things to different people. My brother happens to work at Cambridge Associates, and he has a lot of institutional investors who are very concerned about ESG to the point where they're not as concerned about return, but want to make sure they're invested in the right thing that's consistent with their mandate. The problem is there are a lot of funds out there who are quote unquote greenwashing. They are marketing the fact that they are ESG friendly, but in reality, they don't have the background or the ability to pick stocks that are ESG friendly. And this is really where the SEC is focused right now. Of course, ESG is a huge hot button for the SEC right now, not only for public companies, but also for private fund managers, mutual funds, ETFs, and they're really clamping down on folks who are marketing themselves as ESG friendly when they really aren't.
And I guess, I'll give you the last word on this topic here. A lot of managers have that because that's what you need to have. You need to have a policy to attract it. But how do you tell it's really part of the DNA of the firm?
That's a good question. We represented a few years ago, a private equity firm in the renewable space. And their whole firm was ESG and every sort of thing like that. I mean, they operated differently than most of the funds we talked to. A lot of the funds, I think it's not even relevant. Like it's not quite sure if it matters for some of the funds, but we really, honestly, at Perkins, it's not something that we have been impacted by a lot. We're not representing, the guy who's doing, most of the strategies. It doesn't really matter yet. I'm sure we will get hit more and specific funds will get hit. But right now, so far, we've not been impacted too much. It's just maybe not a helpful answer, but
Well, it's
it hasn't
the
been.
truth. That's what we're
Yeah.
after. We want you to speak to what's going on.